about the One Big Beautiful Bill Act specifically for lawyers and law firms, and how we can maximize the kind of result and the effect of this bill and make the best out of it. Okay, Matt, you want to move over? There you go. Sorry, I'm looking at my slides and then that side. So it's basically the key changes specifically for law firms, as we mentioned, and how we can implement tax planning and tax strategies to minimize your liability. Okay, we got to keep in mind that whatever we know, we can know as much as we want to, our entire bill, but if we don't properly plan throughout the year, most of these provisions in this bill will just go to waste. We won't be able to utilize it. And for that, I created this, you might have heard me say that in the past, but I created this small, fun acronym with 3 letters, PRO, pro, because lawyers are professionals. We're not amateurs. For that reason, we are pros, and the pro stands for planning, roadmap, opportunities. The planning is, we have to plan throughout the year. That's the P in the acronym. When we plan, we create a roadmap for ourselves. With the roadmap, we create opportunities, PRO. So that said, please keep in mind that most of these provisions that we'll talk about are great. It's going to probably help you as a law firm partner and owner. But if you don't plan accordingly throughout the year, you might miss out on huge opportunities. We plan to create that roadmap to create the opportunities. We don't want to miss out on the last one. Okay? With that, the agenda for today is we're going to kind of talk about 3 pieces of this, the bill, the One Big Beautiful Bill Act. We can call it OBBBA, OBBBA, whatever we want to. OBBBA is actually not a bad thing for today. So we use the terminology OBBBA for the One Big Beautiful Bill today. And we'll talk a little bit about what it is. We'll talk about some tax provisions in OBBBA, but put a lot more kind of focus on the business provisions and how to maximize it. Okay? Basically what OBBBA is, it's a new bill that was passed earlier this year, July of 2025. It's a pretty large bill. It's about 870 pages. I'm going to be frank, I haven't read all of it. I would lie if I would say that I have. But I have looked into the most important parts that are relevant for our law firms and law firm partners, and which is what we're going to talk about. A lot of the provisions are extensions of the prior the act to 2017 TCJA Act, which is when Trump took office the first time around and came up with this huge revamp on the tax code. A lot of those were expiring by end of 2025. So OBBBA is extending and either permanently or temporarily most of those provisions. A lot of them are permanent, some are temporary. We need to keep in mind that even though if this permanent, doesn't mean anything, right? Next administration can come in and change the entire tax code again. But as it's written right now, it is permanent, and we'll mention which ones that are permanent and which are not. But even the ones that are permanent doesn't mean that they are permanent forever. You just got to keep that in mind. It can change. Okay, so that's a little bit about the bill here. And what it's doing, getting into the individual provisions here, if we look at this slide here, we have, I'm going to move this over here. We have the rates here with OBBBA and rates without OBBBA. Okay, this would be the rates if OBBBA would not pass. And as of next year, we'll go back to these rates. If you compare it, initial is 10 to 10, that's fine. But the 15% goes down to 12%, 25 to 22%, 28 to 24. See, there are significant changes in the tax rates that will help taxpayers throughout. The big one is here, 39.6 is 37% instead of 39.6%. And these are the income ratios for when these tax brackets are kicking in. So for single filers and married filing jointly filers, there are other filing statuses as a head of household, married filing separately and all that, but just to simplify this slide, we're just using single and married filing jointly taxpayers kind of brackets. Keep in mind here, on the higher brackets, just some fun fact here, most of these brackets are basically for single filers compared to married filing jointly filers are doubling up for that bracket. So 11,000 to 23,000, you see here, it's just married filing jointly just double the amount of single filers, except for this last one, 37% bracket. For single filers, 37 kicks in after 626. You would think that for married filing jointly, that would be 1.2 million and change. But no, it starts at 751. So this is what I call a marriage penalty. There are other penalties with marriages, by the way, but we're not going into it. For tax purpose, there's a marriage penalty for this bracket. So keep that in mind. It is usually good to be married on paper for specific situations, but if you're high tax bracket, both spouses are high tax bracket, you want to be careful with that. You could get hit with a significant amount of marriage penalties, basically. Okay, enough about brackets. We're happy to answer any questions about those if you have any questions. Let's move on here. State and local tax deductions. If you remember, prior to Trump taking office again last time around, 2017, there was no cap on the state and local tax deduction. State and local tax deduction basically is your property taxes you're paying for your property that you own, primary resident, first and second home, your state taxes you're paying, plus some small other taxes such as car registration and all that. Those are a smaller amount. The big portion of the SALT deduction is property tax and state income tax. If you remember, there's no cap on it prior to 17. When Trump took office, he put a cap on that to $10,000. So states with high income taxes and high property values suffered significantly, because prior to this, you could deduct state and local taxes up to hundreds of thousands. There was no cap on it. As of 2017, that cap is 10,000, and it was it would stay $10,000, but with OBBBA, this has been extended or expanded to $40,000 now. So instead of $10,000 cap, that increases to $40,000. So if you have state and local taxes, you could deduct up to $40,000 if you make below $500,000 in modified adjusted gross income. I'm not going to go into details of what modified adjusted gross income is, but bottom line is it's your income, total income after deductions. If you make between $500,000 and $600,000, that $40,000 gets phased out gradually until you come down to $10,000 again. You can't go below $10,000, so the minimum you can get is $10,000. But if you make more than $600,000, you will be capped at $10,000 again. So this is a temporary increase from $10,000 to $40,000. It will go back to $10,000 for all taxpayers as of after 2029. So as of tax year 2030. If you note here, you have this 500,000 limitation for both single taxpayers as well as married filing jointly taxpayers. That's another marriage penalty that I call it. So be careful here. So two single taxpayers would have $1 million limitation to get the full 40,000. One married couple will still have $500,000. Okay, so this is when you got to be careful whether if you're on the edge of getting married, you want to consider this. Okay. That's it. Let's move on to the charitable contribution changes. Matt, you there?
Yes, Emil.
So I'm not going to spend too much time here. Charitable contributions, the 60% limitation on cash contribution of your income, 60% of your total income. Let's say you make $1 million, you can only contribute up to 600,000, which is fine. That's not a big deal. Not many people do that unless you implement very strategic tax planning tools. There are some tools involving charitable donations. In those cases, you might get hit and not be able to deduct all of it. That's made permanent to 60%. Another thing here, for if you're not itemizing your deductions, which means you don't have a property or property taxes or mortgage interest, most likely you're taking a standard deduction. Now with OBBBA, the tax code allows you to claim up to $1,000 per taxpayer, $2,000 merit filing jointly taxpayers, even if you don't itemize your deductions. So here, if you see, we don't have the marriage penalty because it goes from 1,000 to 2,000 from single to married filing jointly taxpayers. Also, a new thing here is the 0.5% floor on charitable donations. If you make $1 million example again, first 0.5% of your income is not tax deductible in form of contribution. So first $5,000 in charitable contribution would not be tax deductible, which could mean significant loss of deduction here. Strategies, tax planning tools for there. That's starting 2026, by the way, the 5.5% floor. Tax planning tool, bunching strategies. Basically, you bunch them together for 2 years at once and pay it at once. So you could pay your 25 and 26 years donations now, end of 25, to be able to take 100% deduction on your charitable donations. And then kind of do it every other year to kind of maximize the deduction. And for bigger givers, consider a donor advised fund, which is basically a fund that you put aside money for future contributions, donations, but you get the donation deduction now. So you could put aside hundreds of thousands of dollars into that fund, get a deduction now, but then decide who you want to give to in future years. So that could be something to consider for tax planning tools. Okay. I'm going to move a little bit faster here on the personal deductions here. Mortgage interest and gambling losses. Mortgage interest deduction is made permanent. The 750,000 limitation is made permanent now, which is just an extension of the TCJA. Nothing new there. Home equity loan interest deduction is suspended unless it's to acquire, build, or substantially improve your property. But these combined, the $750,000 limitation is combined for your primary kind of mortgage as well as your home equity. Gambling losses, there's some limitations there. You can only now deduct 90% of your losses up to your gains. Before, you could just deduct 100% of your losses against your gains. Now you can only deduct 90%. Quick example, you won $10,000. At the same day or same year, you lost $10,000. So technically, it's break even. You should not pay taxes on it. But you can only deduct 90% of the $10,000 loss. So you can only deduct $9,000, which means that you actually end up paying taxes on $1,000, even though if you broke even. Keep that in mind. All right. Some vehicle deductions, interest deductions. This isn't brand new, first time that I've seen it. In the next 25, 26, 27, the next 4 years, you're allowed to deduct your primary, your primary car. This is not business car, by the way. That's separate. Business cars have their own deductions. But if you have a personal vehicle, you can deduct interest on the loan up to $10,000 per year. Okay. And that has to be for personal use. It's not for business use. And this is for interest originated after December 31, 2024. There are massive phase-out limitation. This is only for people making basically anywhere between $100,000 to $200,000. Okay, depending on your marital status. Let's move on real quick to finish up the personal provisions here. Energy credit, I just want to touch on it. If you're planning to buy a electric vehicle, you might want to do it now before end of this month. The electric vehicle credit, tax credit is expiring. It could cost you $7,500 because the tax credit for electric vehicles is still up to $7,500 depending on how big the battery size is. It's expiring December 30th of this year in 12 days, guys. If you're planning to buy it right away. And in order for you to qualify, you need to have a contract in place and put a small down payment down by September 30th. You don't necessarily have to have taken the car in your possession. An energy efficient home improvement, such as solar panels, energy efficient windows, that's a 30% tax credit that's expiring end of this year. These credits were expiring years from now, but with OBBBA, it's expiring away in advance. September 30th again for the car or vehicle credit, December 31st for the energy efficient home credit, which means it's not enough for the home energy efficient credit to have paid a deposit. It actually needs to be installed and ready to use. So it has to be all done, paid for, installed, ready to use in order for you to get the 30% tax credit on it. So be careful with that, guys. That's something that's coming up very, very fast. All right, let's move on to the business provisions here, guys. QBI deduction, a qualified business income deduction. I'm just going to talk through the specified service business angle, which includes law firms, CPAs, financial advisors, doctors, dentists. There are major limitations. This is a tax credit or a tax deduction equaling 20% of your business income, which is fantastic. Okay, you make 500,000, you shave off 20% of the 500, and you only pay tax on $400,000. This is made permanent. This was expiring, so I'm happy that this got extended because it's a very nice tax deduction for business owners such as LLC partners, LLP partners, S-corp partners, even sole proprietors get to take this advantage. But if you're specified service business, such as lawyers and CPAs, financial advisors, doctors, there are limitations. There are phase-out limitations. For merit filing jointly taxpayers, if you make more than $394,000 in 2025, the 20% starts phasing out. Once you reach $494,000, you're totally out. You can no longer get the business deduction, 20%. For all the other taxpayers, these are the limitations, 197 and up to 247. As of 2026, this phase-out limitations are getting a little bit better. So instead of having 394 to 494, we get an extra 50,000. So the threshold limitations goes from 100,000 difference to 150. So it's a little bit better, same as for all other taxpayers. Now, let's bring this up, guys. We're talking the business provisions now, qualified business income deduction. And if you remember, initially here we discussed about the PRO acronym, which is the planning, creating roadmap, creating opportunities. You are a taxpayer. Let's give an example. You're a taxpayer, law firm, let's say married filing jointly law firm, you make $550,000, $600,000 this year. You're above the threshold, you lose out on the 20% deduction. All right. This is when planning comes really, really handy. What do? Let's say we implement a tax strategy. We implement the pass-through entity tax deduction, which I will be talking about in a bit here. But let's say we implement that and we have $500,000 business deduction, business income. We can take about $50,000 in pass-through entity deduction. Let's say we implement another 401k contribution. I'm just throwing out items right now. Not only that, the pass-through entity deduction and the 401k will reduce your taxable income. You pay less taxes on your income. Now, you do not qualify for the qualified business income deduction also, because with proper planning, you brought your income down below these thresholds. So it's a double dipping, basically. It's a snowball effect. You get one deduction, bring your income down. Now, all of a sudden, you qualify for all the other deductions. Same thing with the SALT. We mentioned the SALT deduction earlier, but there are some limitations to be able to get up to $40,000 in SALT deduction. If you're above 600,000, you don't get that anymore. We implement tax strategies, hopefully that bring you down below the threshold. Not only that you qualify for the QBI deduction, qualify for SALT deduction, but also those tax planning tools we implemented reduce your taxable income. So it's a double impact. Okay. I'm going to pause here a second and allow if there's any questions. I'm going really fast right now, but any questions about this? No questions. All right. No questions. It's either very boring or I'm super clear, one or the other. All right, let's move on. We talked about the pass-through entity deduction, right? That was my example to reduce your income to qualify for QBI deduction. The pass-through entity deduction, guys, is a huge deduction. This was expiring end of 2025. It was implemented, by the way, in 2021 as a workaround for the SALT deduction limitation. We discussed that SALT deduction limitation was reduced to $10,000 from an unlimited amount. So certain states implemented this pass-through entity deduction to allow pass-through entities such as S corporation owners, LLC owners, LLP owners, partnership owners, not including sole proprietors, guys. This does not include sole proprietors. So if you run your firm as a sole proprietor, we need to consider entity change to be able to take advantage of pass-through entity tax. It's huge. We see this being missed with a lot of law firms that come to us initially. And it's not because it's very complicated. I'm going to be frank. We're not going to the moon or anything. It's just because they did not have the PRO acronym in their pocket. They did not plan. This tax deduction, you need to plan for it because you need to pay a small deposit, basically. If you have never applied for it before, you need to pay at least $1,000 timely to qualify for this deduction. If you did qualify if you took advantage of it last year, you need to pay at least half of that this year to qualify. If you don't, you would not qualify. Okay, there are some changes to this, by the way, starting 2026 and on, which we'll touch base on as well. But basically what it does, it allows you to pay your state income taxes, state personal income taxes through your business entity. It's a tax that you anyways have to pay from your personal pocket. Now we're just converting that over and paying it through your business entity, LLP, S corporation, whatever entity you're running it, to get a federal deduction on it. All right. So big winners on this, who benefits? It's really taxpayers, business owners with flow-through entities in a high income tax states such as California, New York, will benefit from this significantly. And the calculation, each state has its own calculation on this, but California's calculation, most of you guys are in California. California's calculation is basically 9.3% of your business entity's income. I'm going to give you an example. I recently signed up a new client, law firm, very specific niche law firm, 2 partners making about $3 million profit. Okay. This is a real life client. I'm not going to mention name, but a real life client just recently signed up with us. They did not have the PRO acronym in their pocket. They did not plan for the taxes. They just went to their CPA once a year, had their taxes done. I'm not blaming the CPA for not implementing pass-through because he would not be able to if he sees the client once a year. But I am blaming the CPA because he didn't tell the client that how he could work with his client throughout the year, meet quarterly, talk to the client, plan. Guys, it's super important. So even if they knew about this tax deduction, without planning, you would not be able to deduct it. Let me give you the example now, how much they lost. Started in 2021, this tax deduction, 21, 22, 23, 24. That's 4 years that they missed it out. Luckily, they came to us timely for 25, so we will apply this for their 25 taxes. $3 million roughly, give or take, every year for the past 4 years. That's $12 million in income for the past 4 years. 9.3% of that is the deduction that you're allowed to pay through this pass-through entity tax. which is 1.1 million, a little bit more than 1.1 million in deduction that they missed out on, guys. That's not a joke. That's 1.1 million in deduction. With this income rate, they're about 37% tax rate. Not about, they are in a 37% bracket. The 1.1 million deduction they lost on, they missed out on over $400,000 in taxes. They overpaid $400,000 in taxes in the past 4 years by not taking advantages of pass-through deduction. And this is not a 401k plan that you have to put money in the plan and sit on it for years until you take out. Or this is not a, I don't know, a car that you buy just because you get a deduction. No, this is a tax that you anyways have to pay from your personal account, or we're converting it and paying it from your business account. Please make sure your accountant is taking advantage of it. Talk to your accountant. Big, big, big deduction. All right, let's move on. We're reaching our 30-minute here. If you can give me a few more minutes here, that will be very helpful. Bonus depreciation is a big, big, big deduction. Bonus depreciation of 100% is made permanent. I love this because there's a lot of tax planning that we could do with bonus depreciation, specifically combined with real estate. The bonus depreciation has been in place for several years. It used to be 100% for several years, gradually gone down. It was 60% in 2024. It's 40% this year. In 2025, it would be 20% next year, and then 0 going forward. But with the OBBBA, it's extended to 100% for any property or assets purchased and placed in service after January 10, 2025. Then we have the 100% depreciation. A simplified version, let's say you buy a server for your computer, for your office, for your law firm, $10,000. Technically, you need to depreciate that over 5 years. But with the bonus depreciation, you can take the entire $10,000 upfront. Quick about real estate and bonus depreciation. There's 3 ways you can qualify and deduct real estate losses against your law firm income. If you're a real estate professional, which means you spend more than 750 hours a year within real estate activities, any real estate activities, looking for properties, remodeling, finding tenants, firing tenants, whatever you need to do. Plus 50% of your total activity is within real estate. Okay? That's very hard for law firm owners to qualify because we typically work a lot of hours, and it's really hard to do more real estate hours than law firm hours. Workaround is if your spouse, husband or wife is not working, we try to qualify the spouse as real estate professional. And if they don't work or they have very few hours, they're working at another industry or doing anything else than real estate related work, all they need to do is spend 750 hours within real estate to qualify for real estate professional. And if one spouse qualifies, automatically both spouses qualifies. So this is actually opposite to the marriage penalty, because if you're alone, you're stuck. You have to do at least 50% of your total activity within real estate. But if you're married, you can utilize your spouse to qualify. Short-term rental is another way, Airbnb style. If average stay per tenant is 7 days or less, you qualify for short-term rental and can deduct those losses against your law firm income because it considers it active income now, active losses. Or self-rental. Self-rental is another big, big item where we basically can elect to combine your, let's say you put the property that you buy for your own law firm into an LLC and lease it out to your law firm. We can combine those tax-wise together. Not legally, you don't want to mess that up legally, but just tax-wise, you combine them. And that way we can take the losses from the self-rental. And you might ask me here, why would I want to have a loss just to take a loss? Exactly. You don't want to have a loss, but depreciation with this bonus depreciation in combination with cost segregation study, you can take a massive deduction. I'm just going to give you a quick example. A client of mine here in LA bought a commercial property for their own law firm, $10 million. It's a very beautiful property, by the way. It doesn't have to be $10 million to qualify. It can be a lot less. By the Staples Center, $10 million. We did the cost segregation study for them with engineering company. I'm not doing the cost segregation studies myself. It's a small fee, a couple of $1,000s. You probably can get around with it. And that year, they got over $1 million in tax deduction just by buying that property. Just huge. They just shaved off $1 million from their legal law firm's income. Massive. And you could do that. You could use that cost segregation combination with bonus depreciation for all three categories that we just discussed: real estate professional, short-term rental, and self-rental. Okay? That's a very, very good benefit that you can take advantage of in combination with real estate. Let's move on real quick to the new 1099 reporting requirements. Matt, 1099 reporting.
Yes, Emil.
This is great news for law firms who typically, especially personal injury law firms or other plaintiff law firms that issue a lot of 1099s throughout the year. The limitation has now been increased from $600 per payee per year to $2,000. And that's a very, very great news for us, especially for us who does this for our law firm client. We'll save thousands of 1099s a year, a lot of time saving, and administration work will go down. The due date is still January 31st to issue 1099s for the past year. So all payments made in 2025, 1099 needs to be issued by January 31st, 2026. The increased limitation starts as of payments made as of January 1st, 2026. So unfortunately, the 2025 year's payments where the 1099 is being issued in 2026 is still the prior limitations of $600. Okay. This is a big issue for many law firms, guys. We have a lot of issues with our clients getting W-9s from their vendors. So good kind of practice is to always collect W-9s, which is the form your vendor give to you with their social security EIN number and address and all that, so that we can issue the 1099 on your behalf, or if you do it yourself. Just make sure you collect W-9s before you make the first payment to them, especially if you just a one-time payment. If you pay them, you're never going to see them again. They're not going to give you that W-9, and we will violate the 1099 filing requirements. And you could get hit with penalties for this. So collect the W-9 and input everything in your accounting system, such as in QuickBooks if you use that. That's what we do for most of our clients. The data goes into QuickBooks. We have it. So when it comes to January, we have to issue the 1099. It's already there. The reason I'm touching on it, talking about it a little bit, is because it's a big issue, especially for personal injury law firms and other contingency-based law firm that issues a lot of 1099. Okay? All right. I went really, really quick because the material was more than just 30 minutes, and I apologize for going over here. Let's move on to questions. Any questions? No questions. Oh, not that one. No questions at all.
Hey,
Wow.
Emil, I have a question.
Yes.
Thanks for the presentation. I was wondering if the pass-through entity deduction applies to anything other than state income tax, or any other state taxes that aren't, I guess, federally deductible that it might apply to, or
Really, any state and local taxes that typically qualifies for the SALT, basically. Was it SALT or PT? Sorry, you talked about PT. I'm sorry, I think I misunderstood you. PT deduction or the SALT deduction?
the PT, because I don't think, well, I guess either one really, but I was asking about the PT.
Okay, so the PT is based off of your business income only. So it's a work around the SALT deduction, but it's really a business tax deduction against your state income tax only. So
okay. The reason I ask is I'm in Washington State, so there's no state income tax, but they do have B&O tax, and I'm assuming I don't even know, is that deductible from your federal return? Yeah.
So if you don't have a state tax, then it doesn't qualify. You don't. Most likely you don't have that, so you would not comply with this. I mean, it would not apply to you.
Right. How about the B&O tax? The
The B&O?
mm-hmm.
B&O. You want to explain B&O?
Business
Sorry.
and operations tax.
Yeah.
Excise tax.
Yeah, no, it's against your state income taxes. So
How about the salt?
it is no, it is against the SALT, but the calculation is on your state income taxes. So it is. How to explain this? It's a workaround for SALT, but no, again, it would not apply to you. Sorry, because you don't have a state income tax. It's basically, it allows you to pay your state income taxes through your business. That's the only thing it allows you to do.
How for the salt? That's state and local tax, right?
SALT is state and local.
Yeah. So would the B&O tax fall under that?
No, because again, the PTE is just against your state income tax. State
I'm talking
income
about
tax
salt,
is
not the PT. I'm talking about salt.
I exactly. Okay, so we're done with PTE.
Yes.
Okay, sorry. Okay, that's a different question now. So the SALT is your state and local taxes. Your business taxes would not include in SALT because that's in the business you pay through your business. The SALT is only on your individual individual return, unfortunately.
Okay, thank you.
But the SALT does include your property taxes. So the property taxes is part of SALT. Those are the big items. State income tax and property taxes are the big items for the SALT deduction.
All right, thank you.
All right. Anyone else? Anything else that we have here? Guys are a easy audience here. Appreciate it. All right. Let's move on real quick. I just want to, as I have you here, highlight the book that we recently launched, Counsel to Counsel. So if you're a law firm partner, you might want to check it out. It's a very easy read. It's my first book that I wrote, so be easy on me with your how you read it. But it's very practical book. It's about my clients, more or less, examples of success stories and other examples with less success stories, and how you can start and grow your own law firm the way you want to grow it. It's basically how you can convert a practice to a business. That's a big issue that I see with my law firm clients, where we are professionals. We're trained to be professionals, and we run it as a professional firm, which is perfect. But we also, unfortunately, in order to scale an operation, need to put on the business owner hat on and convert the practice to a business. And it's a lot of examples about my mistakes and what I've done in the past, mistakes, and how you can avoid those mistakes yourself. So it's on Amazon. We got pretty good reviews on it. We got #1 bestseller in 4 different categories here. So we're proud of this book. So hopefully you will read it, and would love to hear your feedback on it.
Definitely, if everyone has the time as well, as a thank you for coming to this presentation, we're actually doing a free giveaway of the book. So if you have the time, you can simply scan the QR code or visit the link listed, or you can give us an email at info@counselcpas.com. We're more than happy to send you a copy of the book for your reading.
Absolutely. We'd love to do that. All right. That wraps up today's kind of discussion, guys. If you have any questions that comes up later on, this is my email address. Feel free to reach out. I'm on my email daily basis, many times, more than probably I should. We're very active on social, LinkedIn, Instagram. So check us out, Counsel CPAs. And we'll love to hear your feedback and hear from you.